we'll come to the bond market. Now, we'll touch upon what we just spoke about, the 5.1% of GDP fiscal deficit. Now, if the government, we don't really know what the exact number is going to be. We're assuming it's going to be a 5.1%, but there's still, like we said, there's a moderate possibility that the 5.1 can come down to by 10 basis points to around 5% or so. If that does happen, that will be a positive for bond markets, mainly on account of the fact that if your fiscal deficit comes down by 0.1% of GDP, the government will have to borrow that much lesser from the bond markets, which also frees up money for corporates and for non-government entities and probably also quasi-government entities to tap the bond markets. Now, one thing we really need to understand, so the chart in front of you is your India 10-year bond yields from August 2023. You can really see here that from October of 2023, you can see directionally the bond yields have actually been coming down consistently. A lot of reasons why bond yields come down. So one is your borrowing numbers. If the government borrows lesser. Second is if crude prices continue to come down, inflation continues to come down, if there is ample domestic liquidity, if there is more currency stability, and if there is a lot of money, FII flows coming into the bond markets, you generally see this trend happen. Now, one key thing that really changed around October of 2023 is for a few years now, the markets have been expecting JP Morgan bond inclusion, India being added to JP Morgan's emerging market bond indices. The announcement, the confirmation happened somewhere around October of 2023. And it took a while for the markets to also get a sense as to how this would impact bond flows. And that was combined with the fact that crude prices were coming off. We were seeing incremental stability on the currency. And from around November 2023 on, we started seeing from almost above 7.35% on bond yields. You've seen bond yields come down consistently. And it's currently trading just under 7%, around 6.98, 6.99 as we speak. Now, one positive bump up that it received was a big surprise in the interim budget. When the interim budget was presented, the government was expected to deliver a 5.9% fiscal deficit in FY24. It really surprised markets by delivering a much lower fiscal deficit target for FY24, nearly 30-40 basis points lower. And it continued to project fiscal consolidation for FY25, showing a 5.1% of GDP. So that was one big positive. And just after the JP Morgan bond inclusion news, around 5-6 months later, you had Bloomberg bond inclusion also coming through. Now, why is all of this important? So we'll talk about that in just a minute. Now, the big focus in the debt market space and bond yields has been all through the month of May. You've seen a sharp drop in bond yields from roughly around 7.2%. It's come down all the way, nearly around 20 to 22 basis points consistently. Largely, one, you saw core inflation continue to come down in India. Core inflation currently, as we speak, is at record levels, record low levels. Then you had a lot of RBI's bond buybacks. You had the bumper RBI dividend that we just spoke about a few minutes ago. Then you had news flows from rating agency S&P, a surprise, a positive narrative where they upgraded India's outlook to positive from stable. And FY24, the fiscal deficit number came in much lower. Now, these were a string of news flows that came in and around the end of April and May that led to bond yields coming down lower. Now, the question is, from here, what can pull bond yields lower? Now, one, like we mentioned, aggressive fiscal consolidation that can really bring bond yields lower. Second, if there is a significant ramp up in bond flows on the back of this bond inclusion narrative, that can really help. If US 10-year yields start coming down sharply, that can pull down India 10-year yields as well. Now, markets are now talking about a Federal Reserve rate cut cycle starting in September. We feel maybe early 2025 or December 24 is more likely, but nevertheless, the markets currently are pricing in start of September. As we speak, they're attributing a 70% probability of a September Fed rate cut. We see that unlikely at this point in time, but nevertheless, for whatever reason you continue to see a sharp drop in US 10-year yields, you will start seeing India bond yields also move, at least directionally in that sense. And lastly, any continued stability or softness in crude prices, that can also give one positive that can also give a positive a spin, rather a positive layer for bond deals in India moving lower. But of all of these, I think these two would be the most important to look out for, at least in the near term. Fiscal consolidation number, that 5.1, is it going lower or is it staying where it is? Is there incremental confidence on the fiscal consolidation path? Is the quality of expenditure much better in the budget? These are some important questions to keep an eye out for. Second, what are the bond inclusion flows looking like? Now, we'll just take another minute on the bond inclusion flows. Now, the chart on the left talks about how much of bond inclusion money has come into India. Now, when we say bond inclusion, when foreign investors are bringing money into India, you will largely see it as FII investment in debt. So year to date, 2024, you've seen roughly around $10 billion of money, $10.6 billion of money that has actually come into FII investment in debt. Equity has seen roughly around 1.9 billion. But of this 10.6, not all of this has come into all the FAR bonds. So FAR is your fully automatic route. So ahead of the bond inclusion narrative, the RBI had sort of carved out a set of bonds, a specific set of 29 bonds that were under the fully automatic route, where FIIs would actually bring in money with fairly less amount of restrictions. They could actually bring in money when they wanted and take out money when they wanted. So the FAR segment was carved out for this purpose. And for the bond inclusion purpose, the specific bonds are these 29 bonds, which roughly has a duration of just about 7 years or so on average. Now, of this 10.6 billion that FIIs have brought money into India, a large chunk of it, $7.1 billion, has gone into these FAR bonds. And now, if you look at FAR bond investment in India, you've seen from September 2023, when the JP Morgan bond inclusion narrative started, you've seen the money that goes into FAR bonds see a consistent pickup. And in the month of June, you've seen a fair bit, roughly around almost $2 billion has gone in just into this FAR segment. Now, it is also important to look at this in perspective. As a percentage of outstanding G-Secs, how much do foreign investors hold? It's not a very large number. It's a small number. 2.6% of outstanding G-Secs, government securities, foreign investors hold only 2.6%. Of this FAR segment, they hold around 4.7%. Now, you compare this with how much foreign investors hold of outstanding equity in that segment. Roughly around 16% is what FIIs hold in Indian equity. So given that FII holding of Indian debt is fairly low, is just under 3%, there is a fair bit of an upside that is yet that we are yet to see on the bond inclusion front, and with incremental allocations that FIIs will be doing for Indian debt. Now, why is there so much of focus on bond inclusion? Now, bond inclusion is seen as a very big positive for the Indian economy. And if the reception is fairly positive, markets are expecting roughly around $25 billion from now to the next 10 months of money that is expected to come into India, into this FAR segment from a bond inclusion point of view. Now, a successful bond inclusion will help India see all of this. You will see pressure coming down on the center's need to borrow money from the market. You will see, which will lead to more space for companies to borrow. The flow of money will help the RBI to mop up more forex reserves, really increasing its FX reserves and increasing its import cover. The RBI will also have an opportunity to sort of, when they buy the FX reserves, it releases domestic liquidity into the system that can also ease pressures on short-term rates. These are roughly the positives from a bond inclusion. Now, where does India stand at this point in time? India has stable fundamentals. Its currency has been really very strong compared to emerging market peers. It really tops the other emerging market peers on the currency stability front. India has one of the largest local debt stock in emerging markets, which gives a lot of comfort to the foreign investors in trading in India debt. 9% of local emerging market debt trading volumes. And if you're looking at it from a bond point of view, the holding, like we mentioned, there's ample room for this 2.6% of FII holding to continue to move much higher. Now, a lot of analysts and economists estimates, they expect this 2.6% to go up to as high as 4.4% of outstanding, probably around the same time next year. So from a bond inclusion point of view, the reason it is extremely important to look at what the bond inclusion inflows are like, it will determine where your yield will also be at the end of the month or in the months ahead. Now, how much of money have we received month to date from a bond inclusion point of view? We've received roughly around, in I think the first week or so of the month of post the inclusion. 28th of June is when India was added in the JP Morgan bond index. And since then, around the first week, we've roughly seen around 0.7 billion come into India debt. And if you're looking at it at the FAR segment, we've received around 0.4 billion. Now, if you extrapolate this, this does look like a comfortable number for the month. So by the end of July, I think it is very important to try and see what this number is looking like and track it on a monthly basis. That will give us a sense as to how attractive India bonds are and remain to be for foreign investors. I think that we come to the end of the first segment, which is E, which is economy. Now, 4 short indicators that you have to look at. First is your 4-quarter trailing GDP. You can see around a 50 basis points increase in the March quarter. Now, 8.2% is not going to stay 8.2% consistently for every single year. You will see some moderation in growth as and when global growth also sees a moderation. But nevertheless, the point here is that India growth continues to remain fairly strong. A most important, a very relevant indicator to look at is your PMI numbers that come out every month. For the month of June, we've already seen an uptick in both services and in manufacturing, and sub indices within your manufacturing and services have hit records within your PMI numbers. And your 50 is generally considered an important threshold. Any PMI number above 50 is considered to be in expansion mode, and anything below 50 is considered to be in contraction mode. So from a PMI point of view, India is doing fairly well. You aren't really seeing any particular weakness there. From an e-way bill momentum point of view, these are in absolute numbers. You can actually see where the month of June stood. From an e-way bill numbers point of view, we touched the 100 million mark, well above where e-way bill numbers were in FY24 and FY23 and in FY19. So you can see a fair bit of momentum continuing. Another positive that happened in the month of June was you saw India's current account that normally stays in deficit turn into a surplus for the March quarter, largely on the strength of services exports.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.